Hey guys, it's Akeem here and welcome back to another video. Now we're moving away from the usual stock analysis videos today, but don't worry because it's for good reason. And I think that the value provided from this video will be orders of magnitude greater than any value I could possibly provide analysing a single company. A lot of people have been feeling the pain over the last couple of months with regards to their investment portfolios. And we could talk about a multitude of reasons or possible reasons for what the hell is going on in the market, with everyone having differing views. Some people will tell you it's due to the macroeconomic environment, particularly given the fact that the Fed have just announced that they'll be tapering quantitative easing sooner than anticipated. Others will tell you that it's due to issues brought about as a result of COVID, whether that be the potential for future more dangerous variants, supply chain issues, or labour shortages. And I think we all know that that list could just go on and on and on. But as a long-term investor, honestly, I'm not in the market of trying to predict short-term investor sentiment, whether that is retail investors or institutional investors. The truth is that in the short term, I just don't care. I stick to fundamentals, I have a plan, and that is what we work with. But I'm hoping that you've noticed a theme there, which is that all of the above are completely out of the control of the individual investor. The one most important thing that is not out of our control is the stocks that we decide to purchase. And that comes back to something that I've been trying to preach to viewers on this channel all along, which is that the number one most important thing in investing is valuation. The number one reason your stock might be down as much as 80% from its all-time highs will be because it was grossly overvalued in the first place. So with that in mind, here are 3 things that you should stop doing in 2022. So number 1 is to stop thinking that just because a stock has fallen by 50%, that means that the stock is now cheap or is unlikely to fall further. I can provide you with countless examples of stocks that fell 50% that then go on to fall a further 50% off the back of that. DraftKings, for example, fell 43% from $72 to $41, and everyone was raving about how cheap the stock was. Since then, the stock has fallen a further 40% down to $25. Peloton fell 50% from $167 to $82, and again, everybody was telling me how cheap the stock was. And what's happened since then? But it's fallen another 60% down to $33. And honestly, I could carry on. Think about Lemonade, Roku, Wish, you name it. Think about it like this, and let's just be ridiculous for a moment. If a stock had a PE ratio of 2,000 and the price fell in half, so the PE ratio is now 1,000, does that make the stock cheap? Unless that stock is going to grow its earnings by 100% year over year for the next 7 years, well then probably not, right? Now number 2 is to stop making decisions based on what you see and hear from people on the internet, whether that be people on Reddit, people on YouTube like myself, or otherwise. Even if that person that you're listening to actually knows what they're talking about, and let's be honest, most of us don't, and they know how to analyze a business properly for the purposes of an investment, and then they make an investment accordingly, that investment isn't necessarily right for you and your personal circumstances. What's your risk appetite like? What's your allocation to that particular stock going to be? When do you plan to get out of the market? There are literally hundreds of differences that separate you from the individual that you're listening to. So what is right for them may not be right for you. The analogy that I have for people watching stock analysis videos is to liken it to a blurb on the back of a book. It is a small introduction to the wider story to see whether you're interested in reading the entire book, or in this case, doing the entire due diligence process. And the third one is to stop assuming that a company is the stock and the stock is the company. And what do I mean by that? Well, so often I hear people say that a company is growing its revenues and profits, and therefore the stock is bound to continue increasing in value. And it's a really, really dangerous assumption to have. Because if a stock was already overvalued when you purchased it, then it can grow its revenues and profits all you like, and you still won't see a good return in your investment. Let me give you an example of this. In 1999, Microsoft had revenues of $20 billion. The stock price at that time was $59 a share. By 2015, they had managed to increase their revenues by almost 5 times to $94 billion. Now, if you'd have bought Microsoft stock in 1999 for $59 a share, your investment would have been in the red the entire time in between. And by 2015, it was still in the red at $54 a share. So the next time your rationale for an investment is solely based on the growth of the company, remind yourself that Microsoft shareholders had the same mentality and were in the red for the 17 years following that as a result. Now, something tells me that we're going to be in for a bumpy ride in 2022. Now, that doesn't mean that you should be scared of it, but it does mean that you should be careful in choosing your investments and make sure that you have a strategy and execute on that regardless of what the noise is telling you. Anyway, guys, I hope that you found some value from this video. And until next time, thank you.